how to use life insurance loans to make big purchases without interrupting your wealth growth. Now, what if I told you that you could finance your next car, your next investment property, or business expansion without using a bank or without losing control or interrupting your savings growth? Hi, my name is Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial, and we've been helping Canadians invest in themselves and grow their wealth and pass it on for 15 years. In today's video, I'm going to show you how to use the cash value in your whole life insurance policy to make large purchases like a car or a business investment or even a down payment on some real estate without giving up the growth of your money when you do it. So if you've been following our content, you've heard us talk about things like the infinite banking concept, or some people call it becoming your own bank. Today, we're going to show you how this strategy works in real life and why it's one of the smartest wealth building tools that you can use in Canada. So the traditional way that Canadians make big purchases, right, when it comes to buying a car or making a down payment on a home or starting a business, most people rely on one of three traditional methods to fund these large expenses. And these are the most common. They're not necessarily the most financially efficient, especially if you're trying to build long-term wealth and you want to control your cash flow. So we're going to use buying a car as the example, but keep in mind the same logic applies to any other types of things, whether you're investing in real estate, paying for kids' university tuition, or launching a company. These are the three most common ways that Canadians pay for big ticket items. So number one, you could pay in cash. So many Canadians are taught that paying in cash is the smart and responsible way to make a major purchase. And yes, on the surface, it is a great way to avoid interest payments and debt. But the issue is, like say your car's $50,000, once you hand over that $50,000 to the dealership, that money is gone from your ecosystem. It's no longer working for you. So you're losing out on future interest or investment growth that money could have made. You're losing out on access to the liquid capital that could be used in emergencies or for other opportunities. And you're losing out on the ability to leverage that capital for another strategic financial move. So from a wealth building standpoint, paying cash is a one-way transaction. So you exchange an appreciating asset for a depreciating asset, right? You're changing your cash into a car. And then your opportunity for that compound growth on your money is lost forever. Second, if you're buying the car, is you finance your car through the bank or through a dealership loan. So this is a popular route, and you could do it through a bank or a credit union or the dealership. This may preserve your cash, but it comes at a different cost. Now you're paying interest payments, and you also have lack of control. So when you finance through the traditional lender, you're told what the monthly payment is going to be, and you're locked into that fixed payment term. So say 3 years or 5 years, and you're being charged interest on their terms. So this could be 2, 4, 5, 8%, or even higher depending if you've got bad credit. If you miss a payment or you want to make changes to the payments, you could face fees or you could have penalties. And then at the end of the day, the bank or the dealership owns that loan. You don't. So you're building their wealth, not yours. Financing will give you the car, but it doesn't give you the financial flexibility. You're forced into a repayment schedule that might not match your cash flow, might not match your business cycle if you're a business owner. And then a third way to get a car is lease, right? Leasing is that third option that's really often used for vehicles in Canada. With a lease, you're essentially renting the car for a set period of time, typically 2 to 5 years. It might come with lower monthly payments than a loan, but you're not building ownership or equity. The dealership still owns that vehicle, and at the end of the lease, you either return the car and lease another one, or you pay a buyout fee. So the dealership will tell you how much it costs to just keep the car, or you walk away with nothing to show for all those payments, but you got to use a car for a period of time. So for some, leasing provides convenience, but just like financing, you're on someone else's term and the money that you pay each month is gone. So the common theme around these three things is that you're losing control and you're losing that opportunity for compound growth. So whether you pay cash or you finance through the lender or you lease, the result is the same. Your money leaves your hands permanently, or you're tied to someone else's rules on financing or leasing. And then in each of those cases, you're interrupting the ability of your own money to grow. You're giving up control of your cash flow. But what if there's a fourth option? One that lets you use your money without losing it. One that keeps your money growing, and one that gives you full control over your own repayment terms. And this is what we're going to cover now in this section. I'm going to introduce you how to use a policy loan from your whole life insurance policy to make a large purchase the smart way without interrupting your long-term wealth strategy. So the alternative is to use a policy loan from your life insurance. Let's look at a more strategic way to finance these big purchases. So this helps you to preserve your capital, avoids high interest debt, and keeps your wealth growing long-term. If you have a participating whole life policy in Canada that's been properly structured and overfunded, it begins to accumulate cash value. And this cash value builds over time and it grows in a tax-deferred manner. And it becomes a powerful financial tool that you could leverage for major life expenses. So in this case, we'll talk about buying the car, right? And we're doing it with what's called a policy loan. So what is a life insurance policy loan? It's a special feature of many permanent life insurance policies, and it allows you to borrow against the cash value of your policy without actually withdrawing the money. So in other words, you're not taking your money out, you're using the policy as collateral to access the money. So this distinction is super important for wealth planning because your money stays inside the policy. It continues to earn dividends and compound interest uninterrupted, even when you're using the loaned funds to go do something like buying a car. Another thing is you get fast, flexible access to liquid capital. There's not a lot of paperwork hassles. There's no long approval process. You don't have to justify the purpose of the loan. There's no credit check. There's no income verification. Your approval when you ask for a policy loan is automatic. It's your money. It's your policy. So your money and your policy are the security. So you could think of it kind of like setting up your own private banking system, one that you control entirely. So now how do these policy loans work in practice? I'm going to break it down with a very simple example. So now say you've built up $75,000 inside your policy. You've got this cash value of $75,000. Over a number of years, you built this up. And now you want to make a purchase. You want this $50,000 car, the same one we just talked about. So here's what happens. You borrow $50,000 from the insurance company using your policy's cash value as collateral. Your full $75,000 continues to earn dividends and compounds as if you hadn't touched it. You receive the $50,000 cash within a few business days. It's often faster than a traditional bank loan. And then you decide how and when to repay the loan. There's no rigid repayment schedule. There's no bank, there's no loan officer, there's no paperwork. It's just flexible private financing using your own money. And the biggest advantage is that you control these repayment terms. So traditional bank loans come with non-negotiable terms. You got fixed payments, you have an interest schedule, and there's penalties if you make late payments or even sometimes if you make early payments. With a policy loan, you set the rules. So here's what that could look like on this $50,000. You could pay $500 a month for several years until the 50 grand is paid off. You could make irregular lump sum payments when you have cash. You could pay $10,000, $10,000, $10,000 5 times and be done. You could pay nothing for a period of time. Say you were using the $50,000 to invest in something and you're not going to make money tomorrow, but you are going to make money by the time next year comes around. So you could pay nothing for now and then repay the loan in full or in part later. And you could use a business bonus or a dividend or an asset sale. So as you make some other types of money somewhere else, you can repay this loan when it's convenient. You're not locked in. You're not forced into an uncomfortable cash flow situation. You maintain full control over the loan and over your life. Who can benefit from this strategy? Using a life insurance policy loan to make a big purchase is ideal if you're a business owner with fluctuating income, or if you want to keep your investments intact while still accessing cash, or if you prefer the flexibility over the rigidity of these loan payments that you would get from a bank or a car dealership. If you're looking for different ways to diversify your financial strategy, also great. Or if you want to avoid relying on banks for your major financial decisions. Actually, you'll find in the US, a lot of people who are a part of the infinite banking concept world There's a big distrust of banks, or they don't want to work with banks. So this is a way to finance your life without having to work with a bank. It works a little bit different in Canada. You can't do it fully the same as you do in the US, but a lot of it is the same. So the longer that your policy is in place, the more cash value it will build up and the more opportunities that you have to use it strategically. And now we'll close with this. So why does this strategy work? This is what makes these policy loans such a wonderful wealth building tool. Is your money never stops working for you, right? You avoid interrupting the compound growth of the cash value in your policy. You bypass the bank and you create your own lending system, and you retain full control over how and when you repay the loan. So now here at Safe Pacific, we have set these up for hundreds of Canadians, and we've structured them in the right way to generate a very high cash value. So these are high performance whole life insurance policies that are designed specifically for the infinite banking concept. So if you're looking to make a big purchase, or you want to create retirement income or build intergenerational wealth, this strategy can help you achieve more without giving up growth and without giving up control. So if you think that this would be a good fit, reach out to us. You can get at us through our website, which is safepacific.com. You can send a message there. It'll come to me. Somebody on the team will get back to you within 24 hours on business days, and we'll schedule a meeting. Also, if you enjoyed this video, if you got some value from it, please do all those things that the algorithm likes. Click the buttons, like, leave a comment, share. Don't forget to subscribe. That tells the robots that you like this video, and it tells the robots to send this video to more people that are like you, that are researching how to do better financially here in Canada. That's it for today. I'll see you next time.